My name is Reed Rotino, and today we're doing another episode of Coffee with Scott. I work on the execution services team alongside Tyler and Nan, helping run the execution desk for the firm, and also doing advisor support and helping the advisors with their clients. So today, the topic is going to be Investing 101, an intro and getting started with bonds and equities. Scott Hayes,
Hi,
CEO,
Reed.
President.
Good to see you.
From your perspective, why is it essential for new investors to grasp the fundamentals of bonds and equities? I know that's just from starting from a high perspective.
Sure. It's just important that you know what you're buying, right?
Right.
And equities are stocks, right? Your ownership in a company, where bonds are debt, and it's like an IOU from the company, and they have different risk and return characteristics. Stocks typically are more risky than bonds. They also typically have greater return potential over time than bonds, and the converse, with bonds.
So piggybacking on that, could you touch on how they may fit, one versus the other may fit in your investment portfolio?
Yeah, a lot of it's just based on your age and your tolerance for risk. Typically, when somebody's very young, you're in your 20s and 30s, it makes sense for a long-term investment approach to have a good, healthy allocation to stocks and equities because of that extra return potential. And if your time frame is long enough, historically, the odds of losing money overall in the broad-based index of stocks or basket of stocks is minimized over holding periods of 10 and 20 years, and you can actually end up quite a bit further ahead than if you'd use cash or bonds.
And then starting in on bonds, we'll start there first. Coupon rate and some of maybe the different parts of a bond, starting from a coupon rate.
Yeah, I think it's funny that the bond guy from our bond desk is asking about bonds first. Most kids today, they want to talk about stocks and Robinhood and gamification that's been made trading a real thing. But no, that's a very good point, because bonds are actually very interesting for the first time in a long time. If forever interest rates were pegged near zero, and there wasn't really a wide dispersion of different returns available in different asset classes of bonds. But today we find the environment quite different, because with the bond, as I mentioned previously, it does represent debt, whether it's a government, the United States government issues treasury bonds and bills to help finance their operations. Corporations issue debt to help fund their ongoing operations. And the yields on them vary by the risk, just like anything. The higher the risk, maybe it's a low grade or junk type corporation credit, they're going to require a higher interest rate. A AAA safe, secure bond like a treasury typically has a lower rate than that. And so there's all different ranges of maturities from 1 day to 30 plus years out there. And it's a huge market. The bond market is several times larger than the stock market, actually.
And I know that right now things are a little weird with the current economy, but how does the maturity typically affect the yield?
So typically in a normal environment, the longer dated the bond, the longer that you hold that bond, the more interest you're typically paid to hold that bond, because there's things like interest rate volatility. We don't know what's going to happen in the future. So in a typical environment, investors require a higher yield on that longer dated debt than they do on short-term debt. Now, today we're in a different situation. We talked about this on a prior episode on the inverted yield curve, where you're paid more for short-term debt than you are long-term debt. In fact, we've had 24 months in a row now where that yield curve has been inverted. And it's typically been a pretty good indication of like a recession coming, but we don't know yet today about if that's going to happen or not.
And then let's talk about some of the benefits and risks associated with bonds. Starting with benefits, what are...
So benefits are, in a plain vanilla bond, you clip your coupon, you buy a bond that costs $1,000 is typically the increments are sold in. You get your 5% interest, whatever that interest rate is per year. And then at maturity, you get that $1,000 back that you put into the bond. If all goes well, that's exactly what happens. Now, in the interim period, while you own that bond, depending on if interest rates go up or down, the value of that bond on paper also goes up and down. So we won't get into all that, but it's an inverse relationship. So if you can go buy a new bond at a higher interest rate or higher coupon than the bond you own, the value of that bond goes down on paper. But again, as long as you hold it to maturity, you're always going to get your money back at the end of the day, assuming that the bond does not default.
Right. And then jumping over to equities, you explained how a bond is debt, right? Um, how does equity compare to
Sure. So
that?
an equity, it represents ownership in a company. So if you go out and you buy a share of McDonald's, for example, it's publicly traded. You own a tiny fraction of McDonald's Corporation. So if the company does well, if they pay a dividend, you're entitled to your ownership percentage of that dividend. And also, they sell more hamburgers, they raise their prices, whatever, demand goes up, and they make more profit. A lot of times the stock price will go up along with that, and you benefit from that by owning it because the stock price that you're able to sell it for might exceed the price that you paid for it.
And I'm sure they have different risks.
Oh, undoubtedly, yeah. From the casino, there's all these names I won't mention, but the meme stock craze, if you will, that just has no bearing in reality in terms of fundamental metrics that typically drive prices and earnings.
Social media, do you think that's played a big part in
For sure.
in the rise of the popular stocks?
Well, yeah, to some degree, especially there are certain segments and stocks individually that have been targeted by the social media users to really ramp up their volume and price and short squeeze sellers of the stocks and so forth.
And then there are different types of equities as well. There's common stock, there's preferred stock. What could you explain the difference between those two?
Well, preferred stock typically has in the capital stack, it's a higher claim on the company's resources than common stock. Common stock is below all the debt and below the preferred owners. And basically, typically a preferred stock will have a stated coupon. It'll pay X% for the life of the bond, and it may be perpetual, it may be redeemable at some point in time. Where common stock is really it's just that plain ownership, subject to creditor claims, and you're going to make your dividend if it pays one, and hopefully see some appreciation along the way.
And then is there, kind of touched on this a little bit, but a potential drawback or benefit of one over the other? And it probably depends on everyone's individual situation. And
yeah, it depends on, time horizon, of course, and risk tolerance. But typically, we recommend, particularly in a long-term retirement savings type environment, that you diversify, that you have some of both. Because oftentimes they don't move in the same direction at the same time. With the exception of 2022, usually when the stock market would go down, investors flee to the relative safety of bonds, and they put money into that, which makes bond prices go up. And so there's some offset to each other. So the losses in your stocks may be offset somewhat by the gains in your bonds. So don't put all your eggs in one basket, is that basic philosophy.
This most recent few years, is that the most volatile you've seen bond prices?
Yes.
Over your
for
career?
sure,
Yeah.
without a doubt. There used to be a saying, or there is a saying, that a bad day for stocks is a bad year for bonds. The worst year for bonds up until 2022 was a negative, I think, 4.5%. Of course, they went down 14, 15% in 2022 with everything.
Definitely a wild time. Yeah. So now switching gears, you want to get started in this. What's a good first step in order to start, building your portfolio?
Right. Well, coming from the retirement guy, I always say, if you are offered a plan through your employer's benefit program, take advantage of it. Save in your 401k or whatever the vehicle is. Oftentimes inside the 401ks, you don't buy individual stocks and bonds, but rather something called a mutual fund or an ETF or a CIT. The different terminologies for the same thing, where they just build these baskets of stocks and bonds. Do that first. I also think it's healthy to some of these fintech platforms now, you can buy fractional shares of stuff, so you don't have to have a whole lot of money to get in, and just buy a fraction of a share of whatever it is that you feel like investing in. Something that you maybe it's something that you buy at the supermarket to go, wow, that seems like a neat investment idea. It may or may not be, but you put in a few dollars into it, see how it operates over time. The real way to invest for the long run is to pay attention to the price versus how expensive the stock is. Do they have a moat around the company in terms of future profitability? Are they subject to a lot of competition, regulatory pressures, what have you? But dipping your toes in the water, experimenting a little bit, is a fine way to do it. I would probably say, without making a specific recommendation, that you should avoid options. because every options contract is a zero-sum game. So somebody wins and somebody loses. So the stock market shouldn't be treated like a casino or a game.
Mhm.
But anyway, that's my opinion on that.
And then how important would it be to like outline your goals before do you want to put on paper? Do you want to, or would you want to?
I mean, it just depends. Again, I think it's okay to experiment in the
Mhm.
beginning, dip your toe in the water. But as you get serious about saving, having goals is a great idea, of course. Always recommend that, particularly as you get further down the road. But when you're first starting out, the more important thing is just to get started. The more money you can save, um, the better off you're going to be over time.
Okay.
Yeah. So in conclusion, I would say just get started. Do something,
Mhm.
save money where you can, whether it's one of the fintech platforms or definitely your employer retirement plan, and just get going, and you're going to learn along the way.
All right. Well, I think that concludes our episode for today. Make sure to like and subscribe and tune in for the next episode.
Thanks, Reed.
Thanks, Scott.